Today I'm super excited actually to have Iris Choi to join us because she is an expert in so many of the things that that are affecting us today. So Iris, she's a partner at Floodgate Ventures. Floodgate Ventures was an early investor in companies like Lyft, and they're actually on their 6th venture fund. So she has great perspective in terms of what they've been through. She leads follow-ons investing, takes board seats, drives corporate relationships, works closely with portfolio companies, and serves on a number of boards. She was also an investment banker at Goldman Sachs for 10 years before she went into venture. And she also teaches a class at the Stanford Master School of Engineering that's called Intelligent Growth, that is basically all about intelligent growth in venture investing. So welcome, Iris. Thank you so much for making the time and putting this together for us. Really appreciate it.
Thank you. I'm especially honored to be a part of this because in addition to being an LP, I've just been an early cheerleader and fan of Operator Collective. So I'm happy to be able to participate in the community.
Yeah, Iris has seen this through many iterations. She works with a lot of founders and I'm one of them. So thank you, Iris. So before we get started today, I actually wanted to ask Iris a little bit about, let's talk a little bit about the current market climate this week. You and I and many of us on the phone have all been through multiple downturns at this point. 99, also in 08, and now, and of course this is different than any of the past ones, but we do have, so what are you seeing, Iris? You're working, again, you have a large portfolio, you're working with a lot of your founders, you have your eyes and ears both on the growth funds, the public markets, as well as some of the early stage companies that might be a little bit further along than ours are right now, given that you're on Fund 6. What comments do you have?
Yeah, you know, it's chaotic times right now. And that is kind of the only word I can think about in terms of both how I feel and what we're seeing in the markets is that it's chaos. And part of it is that you referenced this in my intro, but you know, back in 99, 2000, I was actually at an early stage venture fund, which ended up folding. And then I was at Goldman in 08 during the financial crisis. So this is kind of my third downturn that I'm going to be working through. And so because of that, I think that I probably was quick to the punch in terms of reaching out to our founders to have the conversation about the state of venture and startups is likely going to change over the next 12 to 18 months. And I think part of what's scary right now is we're not sure what the scope of it is going to be. One thing that I've noticed is that back in 99, 2000, and then obviously with 9/11, 2001, and then with the financial crisis, it felt less global in terms of the impact on the financial markets, not after 9/11, obviously that was fairly global. But when we talked about the internet bubble bursting back in 2000 and then the financial crisis 2008, it felt like there were definitely large economies like China that were less effective versus with the pandemic right now, all countries are going into lockdown mode. Now, the question becomes in my mind is, for example, the United States going to track the way that a lot of the Asian countries did, where if we self-quarantined early enough, then within a matter of months, things will be to a certain extent either back to normal or back to 80% capacity. I'm sure others on the phone have been watching the news as closely as I have, and in speaking to friends of mine in Hong Kong or in China, you know, schools are set to reopen on April 20th, even though they had shut down for the Lunar New Year at the end of January. A lot of manufacturing plants are back to 80% capacity. So there's the question of, you know, how long will our economy be pressing pause for versus everyone back into business. And I think right now, the feeling of uncertainty is what's causing the public markets, to be frank, to be in a bit of a free fall. I'm sure everyone saw that for the third time in 2 weeks, the New York Stock Exchange had to actually press a circuit breaker and stop trading because the declines have been too rapid just too quickly. I think right now people are still trying to grapple with the magnitude of the change. I was on a call yesterday with actually the Goldman Sachs economists, some of you may have been on as well, where they had to admit that they were very quickly changing the expectations to show that they now expect there to be a global recession, whereas 3 weeks ago when they had a very similar call, they assumed it was more of a, you know, Q1, the effect is mostly felt in China, maybe in Q2 it'll hit the US by the second half, there'll be a full recovery. And I think now the expectation is it will take longer than that. And then, sorry, to your point, question about, kind of advice for founders, I think it is very much around, the state of venture is going to change a little bit in that the types of business models that may have been very popular over the last couple of years when there was a lot of capital that could support companies that had very innovative and interesting business models, but that were capital intensive. I think those companies may be tougher to fund going forward. And part of it is because for a lot of funds who themselves would have been out fundraising right now, the feedback from LPs will likely be, you need to wait because we need to see from our own portfolio how much exposure we have to public markets versus private markets. And so there's going to be, I would imagine, less just kind of free-form capital that's available to put into capital-intensive companies. Now, for funds like yours that obviously recently fundraised, you're kind of off to the races, right? I mean, there's a real reason as a venture capitalist to be optimistic right now, which is if you have funding that you can deploy, I think the expectations by founders hopefully will be less kind of pie in the sky in terms of the valuation and more about how can I stretch my dollars. You know, a lot of the companies that have gone public over the last 24 months were built by founders coming out of the financial crisis in 2008, 2009, where back then, if you wanted to start a company, you had to be some kind of crazy, right? It was not glamorous, and people who had very secure jobs saw them disappear overnight to instead say, I'm going to start something from scratch and then go out there and convince people to give the money, had a different level of grit, I would argue, than maybe over the last couple of years when capital has been much more plenty. And so I think what the hope would be that we will be able to look back in 6 to 10 years at this period and realize that there was a whole new generation of founders that were able to fundraise, build, operate, and execute businesses that were just best in class.
Yeah, thank you. That's super helpful. The other thing is we've always been focused on enterprise and B2B, and frankly, what we are focused on as a fund, as you mentioned, are the things that people should and continue to be using, which is productivity. How do you make people more efficient? How do you work remotely? How do you get visibility into data, supply chains, things like that? And we have looked at, but had shied away from anything that involved physical spaces, for instance, and actually hardware, frankly. And so let's go through now and go through this crash course, which I will let you take it away, and then we'll jump in with a few questions here and there.
Yeah, absolutely. Thanks, yeah, and thank you to everyone for joining us. I think of this as an opportunity for us to provide you literally with a crash course in venture investing, starting with what's going to be a structural overview of a venture firm. And, you know, apologies if I'm stating the obvious for some of you who are more well-versed in both venture investing as well as our active angels yourself. But just wanted to give an overview of some of the basics. And we're also going to be talking about, you know, how to evaluate a deal, the time pressure you're probably going to be operating under, how to think about portfolio construction. And I will fully caveat, like everything I'm going to say, that I am a seed investor. So a lot of this is going to be from the perspective of someone who invests very early on in a company's life cycle. But we have the benefit of Madeline here to balance me out as well. On the first slide, what you're going to see is that this is, again, just kind of brass tacks basics, but most venture funds have limited partners, right? It is going to be a business like any other business where we are getting the dollars that we're going to be deploying from other people, not just ourselves, even though any investor will have to invest into the fund as well so that we have skin in the game. At Floodgate, we have a very small LP base because we are a smaller fund, being a seed stage firm. Mal mentioned we're investing at our sixth fund, which is $131 million. The prior 3 funds were actually at 75. So we actually only have 7 LPs, and they're primarily endowments. And then we have a couple fund of funds. Now, Operator Collective is obviously different in that you've let in a few very select LPs that are endowments, but otherwise it's mostly individual LPs. And I would argue, you know, there's a lot of benefit during choppy times like right now to having a diversified LP base. And so I, again, can't say enough that I feel like Operator Collective is sitting in a great spot and is well positioned to be able to not only make it through this weird economic cycle we're in, but really flourish. Now, so obviously the nature of venture is we raise our funds from these LPs and then we deploy them into startups, but with the intent of then being able to exit those startups and take the money or the proceeds minus our fee, which is both a 2% management fee for the operations year to year, but then also our carry, which is usually anywhere from 20 to 30%. It's almost like a bonus structure. It's what we get to keep of the proceeds before returning the rest of the proceeds back to our limited partners. And especially in the scenario of like an endowment, that usually is their operating budget, all the proceeds that they're getting back from VCs, private equity firms, et cetera, to really operate their businesses. What you'll see on this slide is that when we raise a fund, the expectation is that the LPs are entrusting us with their capital for a 10-year cycle. And the part that oftentimes people don't realize is that really the investing in companies, so the deploying of the capital is usually within the first 2 to 3 years of any fund. And then the rest of the time is for supporting the companies and then ultimately exiting them. But at any given point in time, the VCs that are active should be deploying capital. And so what that means is within kind of 2 to 3 years of launching a fund is you're going to be back on the road raising your next fund. And so you very quickly create a scenario where you have kind of stacked funds where you're actively investing at a, for example, in Floodgate, Fund 6, but the boards of the companies that I sit on, some of them are from our current fund, a lot of them are from the prior funds. And when we have an exit, for example, we had with Lyft last year in 2019, that was an investment from Fund 2. So that was an investment we had actually made in 2009. And so just something to keep in mind is that the path to an exit, I would argue, has become elongated for most types of companies. And so whereas in the past, like Amazon went public when they were 5 years old, I think these days companies are going public when they're fully baked. And so there's a path to profitability before they actually access the public capital markets. And so a lot of times you'll see VCs go back to their LP base, especially in the early stages like seed, and ask for extensions because 10 years is not enough to actually exit most of our portfolio.
Yeah, thank you for explaining that. So enterprise also, the time horizon tends to be longer than in consumer anyway. Yeah. Especially when you're starting at the seed stage. So for Operator Collective, we do some seed stage investing. The core, though, is where we see the beginnings of where they have a minimum viable product. We see the beginning of product market fit and repeatable revenue. It'll still be a long time horizon, but potentially a little bit shorter than what Floodgates are, because Floodgate probably invests, I don't know, a half of a stage even earlier than we do, probably, because oftentimes you're the first institutional check-in. Right?
Absolutely, yeah. And it's funny because oftentimes people ask us, well, what pre-seed firms do you work with? And I think you can get a variety of answers when you ask seed firms that. We would answer none, because there is no stage before seed, right? And yes, there are now institutional funds that say they're pre-seed, but there is, to a certain extent, an attitude at our firm that you are never too early for us to want to invest. Now, in fairness, there are times when I will give founders feedback of like, I want you to test this a little bit. I don't want you to just experiment with my money. I want to know that you've actually run the experiments yourself. But yeah, I mean, with us getting in so early, you know, the average time to an exit is definitely becoming elongated. I would say the other thing that we've noticed is in the past, when private companies were raising funding, they were almost by default dual tracked, right? Which is that you are building a business assuming that you're going to go forward with an IPO. But if you got an attractive M&A offer in the meantime, you might consider selling. We're seeing fewer and fewer of those happening at the earlier stages. So whereas I want to say in like 2012 to 2015, you saw good companies being acquired for, let's say, $300 to $500 million. These days, the companies that are choosing to sell instead of going public are still at the scale of like a Qualtrics, right? Where the night before they were supposed to ring the bell, they sold for $8 billion plus. It's not really like an interim step anymore.
So one thing you mentioned also, Iris, is the follow-on rounds. And I'm curious whether you can share with me. So the initial investment, so you make an initial investment and you save a certain amount, you reserve a certain amount for follow-ons, right? Because once you raise a seed or an A, you want to continue to put your money into the companies that are successful because you want to maintain your ownership stake. And in fact, you exclusively control that checkbook at Floodgate, right? Which is you're the final decider as to whether you're going to continue to fund. About how much do you guys put into the reserve of a fund for follow-ons?
Yeah, and it varies, right? The kind of default, I think, protocol for most funds is it's 50-50. And if you want to do it in the most basic way, people will reserve dollar for dollar versus the first check, precisely for what you mentioned, which is if you want to maintain your ownership over time, then you're going to have to continue to invest. At Floodgate, we decided to do things a little bit differently in that out of our current fund, it's actually skewed more towards first check. So it's 70-30, but with a mandate that the 30% we hold in reserve should only be going to the top third of our companies. And so I think the hope would be that with that kind of mandate, we have to be much more thoughtful and disciplined in how we're actually deploying the capital. Because especially in this day and age, when there are so many funds that are targeting ownership up front, a lot of times the funds that are already on the cap table are being asked to waive their pro rata rights and not actually participate in follow-on rounds. And there, I would say the responsibility or the onus is really upon the early stage investors to earn the respect of the founders that they want to leave them allocation in all future rounds.
And just so, just a reminder for what we're doing with Operator Collective is we have a fairly robust model that we put together for portfolio construction. And after all these calculations, it comes out to about 45% that's reserved for follow-ons. But intentionally, we know that this is a model, and a model that we look at and revisit, because I think it is helpful to have a core model, but we will look at it to say, what are the market conditions? It may be that we end up with something more like a Floodgate, which is a 70-30 model. But it is something that we watch very closely and consult with lots of our experts on.
So now that we've gone through the basics of venture firms, we're actually going to dig in a little bit into portfolio construction. And so if we look at the next slide, what we've actually outlined is the math around what it means to be kind of a top performing fund. And so here we're just using a generic example of if you have a fund size that's 500 million, and if you're looking to triple the fund, and if you triple the fund, in most cases, you really are going to be in the top, at least quartile of funds. Now, obviously, what the expectation is in returns to the multiple that you can return will vary based on the stage that you get in at. But even for the earliest stages, 3x is considered a top performing fund. But if you start off with 500 million, then in the simplistic example, 3x of that is obviously 1.5 billion, which in and of itself, just seeing that number is a little bit like makes you step back because it's a lot of value that's created. But to actually make the math work, because you're not going to own 100% of the company, obviously, right? Even in the most basic scenario, the founders own a portion of it. But the reality is also that you're going to get diluted down over time because other than Viva Systems, there's very few examples of companies that go public after just raising one small round of funding because they're that capital efficient. And so what we show here is that if you owned 15% of your kind of winners at the time of exit, what that means to be able to get to 1.5 billion of value for your own portfolio is that you would need to be associated with companies that had an aggregate of $10 billion at the time of exit. And so the examples we're showing here is that, you know, at the time of IPO, obviously most of these companies prior to the pandemic had gone up in value since IPO, but that you would have owned a portion of Okta and then also Twilio and Fitbit and Grubhub. And we like to just show this to be able to show what it actually means to say like you have a portfolio of winners, because the likelihood is that as a professional VC, just being in one of these companies is not going to be enough. You actually have to be in multiples to be able to have multiples of your fund size be able to be returned to your LP. Now,
sorry, Iris. So 3x the fund. So tell us a little bit about the multiples and the stats out there, because it's all kind of a black box to most people, actually.
Yeah. So the earlier you get into a company, the higher the bar is to a certain extent as to what your return profile should look like. Meaning that, you know, we invested in the seed round of Lyft. We actually led that round. And so you can only imagine, right? When we got in, it was a $5 million round at, I want to say, less than a 9 million post, right? And now it's a company that went public for billions of dollars. And so that's going to be way beyond a 5x. And granted, it was only one check. It wasn't the entirety of the fund, but the magnitude of the multiple return more than made up, you know, multiples of our fund that we were able to return off of that one check alone. But to be fair, you know, there's kind of not that many lifts across most portfolios. And so what's more likely that you're going to want to see happen is that you have greater ownership to be able to make up for that. And so what you see with later stage funds, especially funds that get in at like the A and beyond, is that they will actually more aggressively hold onto their pro rata over time in hopes of still owning, let's say 15% at the time of exit. And so what you see is that like best in class, I would say for a seed stage firm is really 5x and above. But you're really in like the top 5% of funds at that point. And I would say at like a series A, being able to be 4x and above would be in the top 5%. Series B is probably 3x and above. And then beyond that, you're looking at funds that are probably coming in maybe the last funding round before the IPO and just looking to be able to get 1.5 to 2x.
So I think what the number that you hear a lot is that to be in the top 20% of venture funds, you return 3x or above. And that includes the Bessemers, or not, actually, I'm not sure what Bessemers is, the Sequoias, right, and the benchmarks of the world. There was an article recently about Felicis, which just raised their third or fourth fund, 550 million.
Right.
And Felicis, which said that they had a 5.1x return, which is like off the charts high.
Yeah, especially
right?
because they did it across history.
Yeah, and the good news for all of us, though, is that Felicis is one of the few VC funds that we took as an LP in the fund, which means we co-invest with them. So they've been actually really great partners. I don't know, some of them may be on this call. Okay, so actually one other question before we move on to the next slide. As a seed stage investor, being the earliest stage, because that's where there's so many risk factors, right, at that point. And oftentimes seed stage investors need to be very disciplined about the valuation, how much ownership they have, because of the fact that they're going to get diluted and because of the fact that they expect that X% of the companies will fail. What you hear lots of times, and I'm curious, Iris, is this kind of the rule of thumb that you go on? And remember, we're not a pure seed stage investor. We will join some seed, but it tends to be where it's a little bit de-risked, is you hear the rule of thumb, which is we expect that 90% of our companies will fail. And so that's why we need to get a certain amount of ownership with a cap on valuation. Do you guys have some rules of thumb that you abide by, knowing that there's no hard and fast rules?
Yeah. And it's tricky, right? Because obviously we would never write a check in assuming that it's going to fail, right? We're actually at the kind of opposite end of the spectrum, which is that we won't write a check in unless we have conviction that it could be a standalone publicly traded company worth billions of dollars in the future. But I do think that if you don't actually have a lot of your companies coming in at less than 1x, then what I actually fear is that we're not taking enough risk, that we're not swinging for the fences enough. Because at the end of the day, a lot of the portfolio construction math will show you what matters is your big hits, not how many you've lost, because the big hits will more than dwarf the 90% that may go to zero. Although I think in reality, it looks more like a third, which is a third will be the ones that are kind of, 5x plus, hopefully. A third may just be more like 1 to 2x, and then a third may be below 1x. But the hope would be that, most of your companies don't actually go to zero, that you can find them soft landing somewhere and they can at least return the capital that you invested.
Okay, thank you.
Yeah, but so the next couple of slides are actually trying to break this down more from the perspective of an angel investor. How much money do you have to actually deploy or create a portfolio out of, and what does that actually mean in terms of your scale? And so here we just gave an example of if you set aside $250,000 that you're looking to deploy, and let's say you have high level conviction that you're going to be able to be best in class in terms of your returns and you're going to 4x it. That means at the end of whatever number of years you've set aside for that amount of money, that the value in aggregate is going to be 1 million. And you could either get that by owning 0.1% because you've been diluted down of a $1 billion company when it exits, or that you own even smaller ownership but of several $1 billion companies. Now, the one kind of data point that I would keep in mind is for most angel investors, I would imagine if you're doing, let's say, a $250,000 allocation, that's maybe going to be, $10,000, $25,000 checks. You're probably, or maybe you're going to do $25,000, $10,000 checks. But as a venture firm, we have the benefit of when we have a fund, we're doing anywhere from 30 to 60 checks, and we're still hoping to be able to get into one unicorn, or what we call thunder lizards. And so just keep in mind, there is a benefit to actually being able to do multiple checks, because part of it is it's a little bit like Vegas. You're just hoping to hit once. And part of that does require being able to write multiple checks versus if you only write one check, that's obviously putting all your eggs in one basket. We had actually looked up the data when you looked at 2008 to 2010, all the companies that successfully raised a Series A. So that's coming out of the last downturn, where again, that was some gritty times, since you have some of the strongest founders that have been going public recently were started during that 2008 to 2010 period. Of all those companies that not only raised seed, but went on to raise a Series A, which there's already a drop off that happens there, only 1% actually went on to create companies that were greater than $1 billion in value. And so, again, the nature of venture is the odds are a little bit stacked against you. But that's where I would argue having the ability to get into deals that are being vetted not only by Operator Collective, but by the network that's been built. And then obviously the LP base that exists here of operators that have insights that are very different than I think you would get from just having a pure play financial investor. It can be real weapons that you have to deploy, especially during these times. So I think next we're going to focus on evaluating a deal. And here it's interesting because I want to give a sense of the timeline. Chances are if you're an angel investor, you're not going to be the one that's actually putting down the term sheet. And so I want to give you a sense for at Floodgate, our investment timeline usually takes 2 to 3 weeks. I know Josh Koppelman recently at the Upfront Summit said they've been tracking themselves and they can get to term sheet within 9 days. I will fully admit that at Floodgate, sometimes our calendar is our own worst enemy in our ability to kind of just get deals in front of other partners. Most venture funds will have their own way of deciding when to do a deal. Some people are very consensus driven, where every partner has to say yes, green light to this. Others maybe a little bit more single player mode. At Floodgate, we actually say anyone who has conviction can pound the table and can do it. But as a matter of practice, we usually ask one of our colleagues to take a second meeting. And so what we'll see here is if you figure, beginning of week 1, we had that first meeting. Within, coming out of that meeting, we'll know whether or not we're going to ask someone to take a second meeting. We try to get it done within a matter of days. We'll start our initial diligence, and then we will sometimes bring in the founder for an overall partner meeting. But again, it's not required. And so based on how quickly things are moving, we can just give them a term sheet on a standalone basis without getting input from others. Afterwards, we'll kind of do the final diligence, and then that's when we have to start negotiating the term sheet. But, this is the timeline. So if you are considering angel investing in a round, just know that as the founder is meeting with VCs, I think YC recently shared the data point that for their companies that coming out of YC successfully raised a Series A, they took on average 30 meetings with venture firms. So a lot of the upfront time investment is just in having those first meetings. Once you get past the first meeting, the hope would be within a matter of weeks, you very quickly get to term sheet stage. If you don't, that may be a signal that the VC is not actually leaning in that much. And so that's just something to keep in mind. That as an angel, you're kind of waiting until the term sheet actually happens to know what the constraints or opportunities will be in terms of the round itself, because you are unlikely to have a side letter with the founder, and so we'll probably be going along on the terms of whatever is being dictated by the lead investor.
And so for Operator Collective, we often do the diligence in conjunction with the lead investor. Sometimes we get brought in by the lead investor. Sometimes we get brought in by the founder. Sometimes we get brought in by one of our operators. And so what we often do, we tend to be very collaborative, and is we actually exchange diligence back and forth, which has worked out great. So a lot of you guys have all been tapped, those of you on the phone, and so thank you for your continued feedback. It's incredibly valuable, but we use that to supplement this process, so that we're not necessarily duplicating efforts, but we have different networks.
And I cannot emphasize enough in this day and age when so many venture firms are going into rounds saying, I have a target ownership that I have to hit or else I just can't do the deal. Having a differentiated value proposition, not only to the founders, but to the other VC or the lead VC, is a huge competitive advantage, because otherwise you don't want to be left trying to curry favor with either the founder or the lead VC to be allowed allocation, versus the lead VC will understand the value of having Operator Collective, both from a signaling perspective as well as just a strategic thought partner perspective as part of the round. And that's something that I have to say not a lot of other venture firms can claim. So,
and one more point on that. Sorry, one more point on that is that what we have found is that if we can at least meet the founder early enough, and we're early enough in the process, we can almost always, actually, we can always get an allocation that we think makes sense. Where we're not able to is sometimes we meet the founder after it's been fully allocated, and it's pretty hard to then go back and cut other people back. But the other reason why we're able to get the allocations is as soon as we meet the founder, our network, meaning a lot of you as well, we leap into action, literally making intros, giving them feedback on the products. And so that has allowed people to say, and the founder, because the founder CEO is the one who needs to want to bring us in particular. So thank you for all that. Okay, go ahead, Iris. And by the way, one other comment, and is we'll open up the lines at the end for a few minutes of questions. So if you have them, please do save them up for the end, because we'd love to hear them.
So next, we're going to dive into diligence. And again, this is very much through the lens of an early stage seed investor. And keep in mind, again, to my earlier comment about you're never too early to pitch us here at Floodgate, what that also means, though, is that we don't necessarily have numbers or traction to be able to fall on in terms of diligence. And so at the core, there's kind of three general lines of diligence that we're doing, primarily through our conversations. And so I'm going to start with going actually right to left. And so there's this concept of, why is this your life's work? And here what I'm really focused on is, so much of the attractiveness of an opportunity at the seed stage is about the founder. I mean, obviously I don't have to tell the operators on this call that building a company is incredibly challenging, and trying to understand that even for the best companies, right? Again, we've had the privilege of being part of Lyft and Okta and Twitter from the very beginning. You will definitely have 9, if not more, near-death experiences before you're ever actually seeing an exit. And so we want to understand, why does the founder feel personally invested in actually building this company, right? I would love, the ideal situation is a founder who feels a visceral pain point where, if not for them, it is not going to be addressed. And so they feel almost an obligation to society to not only stand up the company, but have it be a success. And that's something that, is incredibly important to us. But I will say, a lot of people don't necessarily test for it, right? We're not necessarily looking to back founders who are coming out of business school saying like, oh, I did a bunch of research and this seems like it's just an interesting opportunity. We want people who feel very passionate about why it is their responsibility and almost their obligation to build that company. And then there's the question of, why now? And this is a little bit of the lesson learned the hard way, where we've invested in companies that sounded like they were going to be incredible, and then they failed, and yet 5 years later someone else builds them and they were incredibly successful, right? And part of it may have been the founding team and their ability to execute, but what we want to know is, why is now the right time for us to actually invest in this company and this company to be successful? And here I give the example of Lyft, right? Lyft 10 years ago, or 10 years prior to when it got founded, wouldn't have made sense, right? It's only because of the ubiquity of smartphones, or primarily iPhones, because that's where they started, and also the accuracy of the GPS within those phones that allowed us to create a two-sided marketplace where you could know down to the city block where both the driver and the rider were standing. And so that's a critically important part. Oftentimes it is either a technology sea change that has happened, or it is some kind of shift in consumer behavior that is making now the right time for a new type of category to be invented. And then the one on the left is this concept of, what is your earned secret? And this is a concept that Ben Horowitz has spoken about at length, which is, what is it that that is usually non-consensus but right, that others have yet to figure out? And that is going to be what gives you the advantage, at least in the early days. And so here, the one classic example is, if you think about Airbnb, their earned secret was not only that people are willing to stay in strangers' home, but that people would actually prefer it to a hotel, right? It's this concept of live like a local when you're visiting a place. But the only way that they actually figured that out was by running experiments. academically, sitting in a vacuum, you would not have known that to be the rationale for why Airbnb would actually be successful. And so there, again, it is helpful to see that a founder, they don't have to have launched the company or have a fully baked product, but they've at least gone through the mind maze to create some kind of, unearth some kind of insight that others wouldn't have. And so next, then we're going to diligence the company just like any other fund would. Now, obviously, again, based on our stage, we may not be able to go as deep into customer references versus how Operator Collective usually will diligence opportunities. But to the extent there are customer calls, we will do that. We will diligence the founder a decent amount. So both speaking to teams that they've managed as well as managers that have worked with them. And then in terms of customer calls, so what we may do is make intros to potential customers and then get the feedback from those customers as to whether or not they are intrigued, whether they want to lean in, or if they feel like, oh, for X, Y, and Z reasons, we're just not even going to take a second meeting. And then obviously we do a lot of work around validating both the market opportunity as well as the concept. To the extent there is traction, we'll validate that. And then we spend a lot of time also thinking through the competitive environment. In an ideal situation, the companies we're investing in are actually creating new categories. But obviously in terms of like wallet and mind share, they would have to probably be supplanting some kind of service that already exists. So we spend a decent amount thinking through the competition there as well.
Great.
And then we get to term sheet stage, right? And here where we spend a lot of time, it is critical to understand, and I can't emphasize this enough, it's like my number one question when I'm working with our existing portfolio as to when they're ready to raise a Series A or B is, why are you raising now and how much are you raising? And unfortunately, the common response is, well, I'm out of money and I want to raise another 12 to 18 months. Whereas obviously the ideal situation, even at seed stage when they're first raising money, is to better understand what are you going to do with it and what is the narrative off of which you'll then be raising your next round, and let's work backwards from there. Right? What kind of traction will you be able to have shown? Who will you have hired for your team? What will your executive team look like? What kind of milestones will you be able to achieve with this fundraising round? And then thinking through very strategically, who do you want to have on your cap table, right? So not only the lead investor, which I often remind our founders, it's easier to get a divorce from a spouse than to get rid of an investor who's on your cap table. But also, like, who else are you bringing into the syndicate? How are you thinking about building out your board? And being very thoughtful and strategic in actually constructing the round that's going to help you be stronger in the long term. And then one of the critical things that we're looking for when you're raising your seed round going into your A is, once you raise that seed round, the clock is ticking, right? And based on how capital efficient you are, you may be able to extend that runway for past 18 months. But I would say on average, with the caveat that I'm speaking in broad brushstrokes, you really have basically 18 months before people are going to be expecting you to raise an A. If it takes you longer than that, it's not by any means a kiss of death, but people are going to wonder why it took so long. If it takes you less than that, people are going to be concerned that you just ran out of money, right? And so really during that first year, you're going to be iterating. And then the hope would be that by month kind of 12 into 13, you have your core product off of which you're going to be showing traction for at least 6 months before you go out and raise your Series A. And, obviously, like, what product market fit looks like can vary in the eye of the beholder. This is actually where we spend the bulk of my time in our intelligent growth classes. How do you assess whether you have product market fit? So if we can go to the next slide, the way that we think about it is actually through this framework, which is a triangle, which is a little bit different than how a lot of people think about it. So there's a lot of great content out there about product value. And so people will say, you have product market fit when the customer is pulling the product out of your hands, or you created moments of delight for the customer. And I think all of that is true, but it's not enough, because there have been plenty of examples, I would argue, especially in consumer space, of companies that got traction with a ton of users who loved the product or service. Foursquare, Quora even, but they didn't actually go on to generate a lot of value for their investors because they didn't necessarily think about fine-tuning their business model upfront. And in the old days, people assumed if you build a large enough of an audience, then you can always figure out monetization later on. But I think practically speaking, that's not true these days, because if you were going to default back to the advertising model, the likelihood that you are going to supplant Google, Instagram, or a handful of other companies, Facebook, to be able to get marketing dollars, it's just not likely. Over the last couple of years, the ad spend has only become more concentrated in those incumbents. And so that's all the more reason why we think it's important that you figure out your business model in the early days and not assume that that's something that you can kind of wait to figure out. It doesn't mean that you necessarily have to monetize on day one, but that you have a sense for what that business model will be. And then, it's also incredibly important that you understand what the ecosystem is going to be around you. Now, so for companies that were creating their own category, so like a Lyft and Uber or Airbnb, there's still going to be the competitive dynamic of the incumbents, however you want to define them, and how they're going to supplant you. There's the regulatory environment where, you know, I think about the number of drone companies that got well funded and then just immediately got shut down by the FAA or other regulatory bodies. And so wanting to figure out upfront how you're going to play in that ecosystem, I think is one that's also incredibly important. So this to us, at least at Floodgate, is how we think about product market fit, where it's not just about the product value, but also taking into account the ecosystem within which you operate or need to build around you, as well as the business model. And that will make you a minimum viable company in the long term.
Great. Thank you so much, Iris. So that was awesome. That was quite a, did we fit it just an entire semester into 40 minutes, I think. It's great. So we do have, so we're going to open it up for some questions. We're going to open up the line, but in the meantime, we have some people who chatted some questions. So okay, I'm going to throw a few of these at you. So going from seed to A can be notoriously difficult. And in fact, there have been some people who say that getting from a seed to an A is even harder for women founders. Mm-hmm. What are you seeing? And is it harder for certain types of companies or founders?
Yeah, you know, it's funny because here I will say at Floodgate, you know, we're 4 GPs, of whom 2 are women, including one of the co-founders. And so I think we just naturally see more female founders in our deal flow than maybe all male partnerships, right? And there was a period 2 years ago where at one point someone external to the firm pointed out to us that in a 2-month period, we had all backed female founders. And, you know, for those of you who know my partner, Ann Miraco, or myself, you know, we're not the type of women who necessarily have gravitated towards identifying as like a female GP. And so it was definitely not because of a quota, right? It was just because the strongest founders we found in our deal flow at that time happened to be women, right? And one of them was building an enterprise company called Workboard that's gone on to not only be funded by us, but GGV, and then 6 months later, preemptive Series C led by Andreessen Horowitz. And then one of them that I'm on the board of is a woman named Nama who's building a company called Cheetah that's very logistics heavy. And then another one of them is in the consumer kind of AR, VR space. And so it's been like a wide spectrum of the types of companies that are female founded that we've been able to invest in. I do believe that the A to B transition can be very challenging. And oftentimes, for me, it's less around, do I notice a pattern of like, you know, fewer female founders being able to make that leap to A? It's more about, I think that a lot of seed-backed founders oftentimes don't approach it from the right mind frame, which is, you know, I'm a big believer in the saying of like, what got you here won't get you there. And even when I'm working with our own portfolio companies, oftentimes when they come in to practice their Series A pitch, it's really a seed pitch, right? It's a lot about vision and why I want to do this, or about the team. And those things are still important. But by Series A stage, there's some kind of data and people want to dig into that, right? And especially these days when there's so much choppiness in the market, the way that VCs are going to think about de-risking the opportunity is by being able to really dig into the numbers and the cohort analysis. Now, the good news is that for founders, there is a lot of content that is available, like Emergence I think made available exactly what they want to see in their Series A data rooms. Social Capital is no longer, I think, actively deploying capital, but they had their 8-ball metrics and a lot of their cohort analysis that can still be found online, so that you can be well equipped going into those conversations with the type of data that people are going to be looking for.
Great. So if anyone has questions, you now have the ability to unmute yourself and ask. So feel free to do so, and I'll pause for a moment to see if anyone has any. Otherwise, I'll keep reading other questions. Okay, so so the companies that you see that have not made it, the third that maybe don't make it or don't get above the 1x to get to the next round, are there patterns that you can see with respect to either founders or is it the areas of the business or otherwise?
Yeah.
Types of businesses?
Question. Yeah. So, I mean, one thing I kind of think about it as like, okay, so the companies that weren't able to actually get out of the starting gate, I guess one kind of commonality would be the lack of capital efficiency, right? And so, again, it's challenging, I would say, over the last 3 to 5 years. You know, even in seed, we went from being, when Mike started Floodgate back in 2006, it was really him, Steve Anderson, Josh Koppelman, and Iden, right? Maybe there was like 5 to 10 seed funds. And I think the latest statistic is there's 880. And so there's an abundance of capital. And so it is tempting, I can understand from a founder's perspective, especially over the last 3 years when really people were rewarding triple-digit revenue growth rates without necessarily thinking through, is this a sustainable business model, to say if I put enough numbers on the board, then I can at least get the next round of funding. And I feel like, unfortunately, people lost sight of the fact that what's important is not just being able to get at the next round of funding, it's the company you're actually building and how is it going to be long-term sustainable. And so one commonality I would say is not thinking enough or prioritizing capital efficiency, because the expectation was always that someone else can just fund me later on, versus once you even take that first venture check, you are obviously not only giving up equity ownership in your company, but some of the power and the ability to influence what the future outcome is going to be. And so I would encourage all founders to always think about it from like, you know, how can I be more capital efficient, so that you can weather a downturn like the one that we're probably going to enter. I think the other part is still that question about, you know, why now? And obviously, like, that's something that we try to solve for in our diligence in the early days, but sometimes we get it wrong. And some of it will be, we assume that there is an infrastructure around it where what we think we're investing in is a software only company. And yet the rest of the ecosystem's not there. And now the company all of a sudden has to start building the hardware to be able to deliver the software. And that becomes a very different margin profile than what we were expecting. And especially if what you have on your cap table is only seed investors, it's going to be tough for your current investors to be able to finance you through that kind of, you know, not even a pivot, but evolution of your business model. And so having the right kind of investors on your cap table and having it diversified in case you need to go through that type of transition is something that I spend a lot of time working with our founders, especially as they're raising their A, who can complement who's already on your cap table.
Yeah, that's a great point, because that is what successful seed and early investors do, which is you're setting up a strong network of trusted later stage investors who trust you as well when you bring them deals, so that they will support that company, because at some point you're going to tap out, or you're going to only take a very small amount going forward, because just the size of the fund and the nature of your model. And so that is something that I think is not necessarily talked about or is evident until you're really in it, because the credibility and the relationships that you build are key. Let me pause again, see if anyone has any questions, or else I will take some more from the chat. Okay, so okay, go ahead.
Hey, this is Laura. I'm one of those people that just has to be a founder. So recently I left Wall Street to be a founder, and then I left VC to be a founder recently. Nice. And it's very early stage for my new company. And it's generally working on finance for basically seed stage companies. And my question is, you know, sort of looking at, you know, 880 seed funds and thinking there's going to be a lot of companies seed funded in the next 18 months. And my question is that still a good assumption, or is there another segment like middle market or enterprise that you think is better to serve given and changing day to day, obviously, but given what we know now.
Yeah, it's a great question, right? I think that there are a lot of companies that have been seed funded, and in these types of environments, the percentage that will be able to make that leap to A will be even smaller than in a frothy market like we've had over the last 3 to 5 years. I will say that with a lot of our companies, what we've been counseling them on is not only do you need to be able to make the hard decisions where you can extend your runway to at least 12 to 18 months, but that you need to have a very hard look at yourself and your business model to see if your business model is the type that's going to be fundable in 18 months. And what I mean by that is, when over the last couple of years, we've seen companies like WeWork or very capital intensive companies get funded, and there's always someone else ready to fund them once they burn through the $50 or $100 million that they went through. And again, we're seed investors in Lyft, so I'm not by any means like throwing shade at other people saying, how could you have invested in such a capital intensive company? But I think the question will be, okay, well, let's say this is just a blip in the market, and then we're in a situation where the economy is humming again in 12 to 18 months. I'm just of the more conservative mindset that the types of companies that people are going to be looking to fund in the venture environment in 18 months are going to fundamentally still look different than what they look like over the past 3 years. And that people are going to be really, again, prioritizing capital efficiency and how much can we stretch the dollars that we're investing in this company. I think that, there are companies that have been able to get to profitability off of just one round of funding. I think the challenge becomes a lot of them are going to be subscale to what like a middle market PE firm is going to be looking for. We've been fortunate in being able to exit some of our portfolio companies, so like Vista, where they were bolt-ons to other assets that they had already invested in. But otherwise, I'm seeing a new breed of private equity actually looking at venture-backed companies, but they're looking for at least 10 million in ARR and profitability.
Can I just ask a direct question? Do you think those 880 seed funds are going to continue to make investments, or do you see a world where they pull back and wait?
So I think that especially at the seed stage, people who are already funded will continue to make investments. I don't think that they're going to be looking to press pause. The question in my mind for a lot of those 880 seed funds is, well, two things. One is that if you look at the funds, a lot of them don't lead, right? So they're just, they're kind of sliding in as part of the syndicate, which is fine. But I think that's less differentiated. And the question becomes, a lot of those are first-time funds that have yet to have to raise in a down cycle. And so I am curious to see if in like 2 years, it's actually the same number of funds, if it's more funds or actually fewer funds. I would have the same kind of question around a lot of the micro funds that you see where it's solo GP raising 4 million. There's always a question of like, who can actually raise funds 2 and 3 as well.
Right. And no concern about LPs defaulting yet or not doing capital calls.
I mean, again, it will depend on who you have in your LP base. There is the risk, maybe counterintuitively, that if you have a lot of endowments or these large traditional limited partners, they will have the denominator effect, which is, they are fairly conservative in saying we have a certain percentage of our portfolio is in public markets versus in private markets, right? And we're solving for liquidity, but also high growth potential, et cetera. Well, when the value of your public market has gone significantly, but your paper value of your private hasn't, all of a sudden it looks like you're overexposed to the private sector. I don't think we're in a crisis mode, which we have experienced in the past, where all of a sudden LPs will stop doing capital calls or say, I have to immediately readjust and start selling my stake in venture portfolios. I think it would be premature for me to say that that's going to be what happens. But I do think that it will be more a question about if new funds come on the market, or will they want to invest in those, or will they say, we're kind of satiated for now in terms of exposure to private markets?
Yeah, I think that that's the case because those large institutional investors, of which we have some in the fund, are very aware of what percentage of their portfolio falls in each market, right? And the public equities are falling, so the venture looks larger. I've talked to some of our large LPs, our institutions and foundations, and they like the fact that, one, we've only deployed 10% of our funds so far, so we have plenty to we don't have to make judgment calls right now as to which one of our existing companies are going to succeed or not, and which ones we're going to continue to fund. We can make decisions as to our new investments. And then second, they like the fact that we have more visibility into the companies and their ability to be successful, whereas in the public equities, they're just subject to what the larger market is going to do. So we have time for one more question because we've got 2 minutes left. The last one is how do you target 15% ownership when it depends heavily on the valuation and size of the raise?
Yeah, no, that's a great question. And so I think here it's important to know what your core product is, which is if you were to ask us at Floodgate, what we would say is we are still looking to write checks that are, let's say, $500,000 to $3 million, but really let's center that at like 1 to 1.5 million for 15% ownership. And that means we will get priced out of deals, right? It means that we are probably going to pull back on doing a lot of YC deals where they're at safe notes of like $12 million and we don't really know what our ownership is until they do a priced round. And what that means is that we need to try to get to the founders earlier and convince them that they want to get a term sheet from us, that raising less is better for them so that they actually have the guardrails in place where they have to be disciplined, or that we're basically not going to just make this an auction process where we're going to bid up the valuation. And so I think that, again, having that kind of negotiation is easier to a certain extent. It's never easy, but it's easier when you have a reputation or a value proposition that's differentiated versus other firms. Now, in full disclosure, at Floodgate, we don't have a platform, right? So we're not going to do your recruiting or PR for you. But what you will get is for partners who had been through several cycles and feel like we're experts in that 0 to 1 phase of company building. Now, obviously at Operator Collective, there's a whole list of what you get when you take money from Operator Collective, but I'll let Malin speak to, I'm sure there's many reasons why, you know, A, you're able to get allocation, and B, you know, at very kind of attractive terms.
Great. So we are up at 1 o'clock right now. I want to say thank you so much, Iris. This was incredible.
Yeah.
This was so useful. Thank you for taking the time.
Absolutely.
And thank you for being part of Operator Collective. Thank you for being part of it from the very, very, very beginning when I first talked to you about this idea that I had. And it's awesome to be working with you in all sorts of capacities. And thank you everyone for joining today. And there will be a follow-up survey. So we would love feedback. We would love feedback on what you would like to see and hear about and learn about for the next cluster of OperatorED. If you have any suggestions or otherwise for that, or even about how do we continue to build community in this distributed work from home world, please, this is your community too. And we love to have you a part of it and want your ideas as well. So thank you very much.